Introduction. The Intelligent Investor by Benjamin Graham is arguably the most well-known investing book on the planet. First published in 1949, the book is highly regarded and has laid the foundation to what is referred to as value investing. Graham's timeless principles and strategies continue to resonate with investors of all levels. Warren Buffett read this book at only 19 years of age and said the book changed his life. He also credits the book for laying the foundations for his investment strategy. Today we'll be going through the two chapters Buffett deems the most important and the most relevant for today. Chapter 8. The Investor and Market Fluctuations. Chapter 20. Margin of Safety as the Central Concept. Chapter 8. The Investor and Market Fluctuations. Chapter 8 introduces the concept of Mr. Market. Graham says the biggest advantage of being an investor is that he or she is rarely ever forced to sell his shares. An intelligent investor only pays attention to the stock price when it suits him. The investor who permits himself to be worried by unjustified stock price declines in the stocks he owns is essentially transforming this huge advantage into a significant disadvantage. For example, Graham wrote, "Imagine that we own small shares in a private business that costs us $1,000. One of our partners is called Mr. Market. Mr. Market is a very obliging partner. Every day he tells us what he thinks our interest is worth, and furthermore offers either to buy us out or to sell us an additional interest on that basis. Sometimes his idea of value appears justified and plausible by business developments and prospects as we know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If we are a prudent investor or a sensible businessman, will we let Mr. Market's daily communication determine our view of the value of a $1,000 interest in the business? Only when we agree with him or we want to trade with him. We may be happy to sell out to him when he quotes a ridiculously high price and equally happy to buy from him when his price is low. But the rest of the time, we would be wiser to form our own views of the value of our holdings based on full reports from the business about its operations as well as its financial positions. Example of Mr. Market and market fluctuations. Let's say you own shares in Microsoft. Every day you get a price that you could either buy more shares or sell your existing shares. This price is called the trading price, and it fluctuates throughout the day, week, month, and year. Let's say you believe, based on your analysis and intrinsic value, your Microsoft stock is worth $200. If the current market price of Microsoft is $150 a share, you don't have to sell because you aren't being offered what you believe the stock is worth. On the other hand, if you believe that Microsoft stock is worth $200 per share and the market price is $250, you could decide to sell your stock because you are getting more for it than what you believe it is truly worth. The main point of this chapter is that you shouldn't let the movement of a stock price influence what you think the worth of a stock is. You should do your own fundamental analysis of the business and determine what you believe the actual value, intrinsic value, of the stock is. In addition, let's say you value Microsoft at $150 per share, and you decide to buy some at that price. Shortly after buying it, the price drops to $90 per share for no reason. An intelligent investor would reassess the business to check if their underlying fundamentals have changed. If not, based on your $150 per share valuation, you could take advantage of the $90 per share and buy at a huge discount. Buffett states, "Never sell just because the price went down. Be greedy when others are fearful, and fearful when others are greedy." Chapter 20. Margin of Safety. This chapter introduces the most important concept in investing. This concept is known as margin of safety. After finding the intrinsic value, discounted cash flow analysis, of a business, we need to realize that we can't predict the future and our calculations are probably wrong. Thus, we need to apply a margin of safety as a safety net for our valuation. For example, say I value American Express at $320 per share. To be safe, I apply a 30% margin of safety, recommended, to my intrinsic value, giving me a price of $224 per share. The bigger your margin of safety is, the more safer your overall investment is. The benefit to applying a margin of safety is that it reduces your risk of losing money, which is Buffett's first rule of investing: don't lose money. Conclusion. The Intelligent Investor by Benjamin Graham is arguably the most well-known investing book on the planet. First published in 1949, the book is highly regarded and has laid the foundation to what is referred to as value investing. Graham's timeless principles and strategies continue to resonate with investors of all levels. Today, we've gone over what Warren Buffett deems the two most important chapters, Chapter 8 and Chapter 20. Thanks for watching and subscribe.